Welcome back. It has been a while since the last time we had a paper on bankruptcy. And today we're happy to have Jun presenting a paper on Fintech platform to us, and I hope that you will enjoy. John Campbell from Harvard will discuss this paper. Jun, the floor is yours.
So this paper is joined with Claire, Hong, and Xiaomeng, both junior faculty from SAIF. So we are very happy that we have this platform to share our research. Of course, we're super excited that Jiao is our discussant. So I have 25 minutes and I have a lot to say, so let me get right to it. So what's unique about the current wave of Fintech is that we see these huge Fintech platforms created by tech firms, but not finance firms. So these tech firms, they are known to have huge, giant user bases, very low operational cost, and a culture of winner take all. So if you think about in the history of tech revolution, finance has always been at the forefront of adopting to new technology and to make it to its own usage. But what's interesting for this round of Fintech wave is that finance is on the sideline and tech firms are taking the share or disrupting the finance firms. And the Fintech platforms, how do they deliver? The vehicle for the delivery of the content is through these super apps. So in a way, these financial services are actually delivered directly to household, free of the traditional financial advisors. And also they get to pack a wide range of products into this one super app. So Bernie said that maybe, people outside of China don't know very well about this super app. So this is a screenshot, 3 screenshots of Alipay. Okay, so this is something we use every day, multiple times every day. So on this front, there is this panel where we do pays. You can scan, you can give them your QR code, and you pay. So here, there is a little tab, which is, you can buy mutual funds. And here, this is another link, basically you go to Taobao, which is Amazon equivalent in China, okay? So moving on to the next page, you basically, through this super app, through this Alipay, you can do payment, you can do online shopping, offline consumption, and investments. And also you can pay your utility bills, your phone, you charge your cell phone through that payment. And the last page, you see that this is a page of mutual fund investment. So here in the example, it's a mixed mutual fund, and it gives you performance and net asset value. So effectively, you're shrinking all the kind of Wall Street banks, Main Street banks, Wall Street banks, Boston's asset manager, Connectors insurer, Amazon shopping cart. You basically cramp them into this one super app, and this is what's unique about the current current wave of Fintech. Another unique aspect of this current wave of Fintech is that it's happening in China. Okay, so in China, activities that are central to household finance, like consumption, investments, and the payments, they are all taking place. Not all, but a majority of them. A non-trivial fraction of them are taking place on these Fintech platforms through these super apps. So in a way, this is not, if we think about Fintech, it's more like aspirational, so something in the future. But what's interesting in China, through the past few years, it's not in the future anymore. It's really already happened. So this is kind of what the current situation is in terms of household finance in the age of Fintech. So when we were writing this paper, when we wrote the first draft, we have Jiao very much in mind, because Jiao in his 2006 AFA presidential address, the title is household finance. So he gave the name to this, this subfield in finance, household finance. And he posted in the first sentence of his abstract, he's posted these challenges for household finance, academic studies for household finance. So the first thing is it's very difficult to measure. So 15 years later, now we are 2021, 15 years later, we have this new kind of data set from fintech, because the nature of the fintech, you get to store all the information on the platform, and the fintech platforms are in possession of this data. So we get from Ant Group 50,000 user accounts. We have their consumptions. We actually have their different components of their consumption. We have their investments. We actually have different components of their investments. Okay. Moving to the right panel. This is a plot of this 50,000 individuals in aggregate. And broadly speaking, there are three categories from consumption first. So these are consumptions that occur on the Taobao platform. So from 2017 to 2019, early 2019, we have a time series of this online consumption on Taobao. And the scale is in millions of yuan. So initially, they are around in aggregate about 70 million yuan in aggregate for these 50,000 individuals. And as you can see, Taobao has stabilizes in terms of a new innovation, because it happened around 2003. So you can see over time, it's a pretty stable time series. There are peaks, there are peaks happening for people living in China. This is a very visible trend. These are November 11 shopping days. Okay. And there are bottoms, valleys. These are Chinese New Year's. Okay. So relative to that consumption trend, we also have two more. Investments is something interesting. It happened around late 2012, early 2013. In China, you can buy mutual funds through platforms, through these third-party fintech platforms. So here we have these mutual fund purchase. We split them into risky funds and money market funds. And the third dimension of our data probably is the most innovative and interesting is the payments. So these are consumptions occur through Ali payments, and excluding the online consumption like Taobao. So this is separate from Taobao consumption. So these are Ali consumption payments. Okay. And you can see there is an overall trend, and we're gonna take a full advantage of this trend later in the paper. So clearly you see a revolution happening in the fintech space, looking at that trend. In the beginning, Ali consumption and the Taobao consumption are of the same order of magnitude. Towards the end of this period, we see that Ali consumption is about double the size of the Taobao consumption. So this is on the data set side. So going back to John's challenge is that these are very difficult to measure. So prior literature use survey data, use tax records. Jiao also works with Swedish data. We also have Finnish data. These are all really cool data sets. So here we are looking at a kind of a new wave of data for household finance research, data from fintech. Another constraint or challenge Jiang talked about is these constraints. So if you think about the literature of household finance, household risk taking, there is limited participation or under risk taking. And when the literature looks at this puzzle, under risk taking puzzle, they think about various costs. So it could be physical cost. It's just not very convenient. Transaction cost might be very high. Access to information might be limited. Or psychological cost, people just don't trust, or financial literacy is limited. So our first question in relation to that observation is that, can fintech lower this barrier? So because of this convenience or low transaction costs, ease to access information, can fintech lower the barrier? Because of repeated usage of these super apps, can investor build familiarity, build trust, and somehow learn more about finance through these fintech platforms? So we are thinking maybe fintech can help improve households' risk taking. So that's going to be the first key research question for us. The second research question is, once we can establish that improvement, then who benefits more? Of course, it would be those who are otherwise more constrained prior to the arrival of fintech. So we are looking at two types of angles. One is investors who are more risk tolerant. So they were otherwise more constrained. With the fintech, they will, the improvement is for fintech advancement will be higher. Another, perhaps more important, is that for individuals living in areas that are underserved by financial institutions, for example, emerging market countries, they, because of the limitation in financial service, the entrance or the arrival of fintech might help individuals living in those areas more. So these are the two angles we want to document as well. So in trying to show that fintech really can help improve, you kind of need a variation in fintech availability. You need the before and after. So as you see, our data is really just the platform activities. So this gives us this challenge in identifying the variation in fintech adoption is the first challenge. And we responded by taking advantage of this technology development from 2017 to 2019. So the blue line here.
Jun, I would
Yes.
like to just remind you the 10 minutes left. Just making
okay.
sure.
Did we start at 10:05? It's okay. My clock says 15 minutes, but
Yes, it is. Good.
Okay. So so the blue line is the ratio of Alipay to Taobao. Okay, so you can see, and the scale is on the left. You can see, as I said earlier, before it's 1:1, and later it's 2:1. Okay, so you see an overall trend in the blue line. Okay? And behind that blue line, we also plotted together with this offline payment here. So behind that blue line, the trend is this emergence of offline QR scan. So this is on the left panel. So for people living in China, you probably don't remember when the first time you are using this QR scan, because this is part of our daily life. So I searched online, and this is an article in Shaoxing, where Ziguo is from, and many other famous literary figure in China is from. So back in 2017, it says that now you can do grocery shopping. You can go to farmer's market and use the QR scan to pay for your vegetable. Okay, so Shaoxing, as you know, it's a city, I shouldn't say small, it's a city close to Hangzhou, and it's around 2017. So here, behind this trend, both the red line and the blue line, behind that trend is this new technology called QR scan. Okay, so taking advantage of that, for each individual, and for each month, we measure their Ali fraction. So we measure their Alipay as a fraction of their Alipay consumption plus Taobao consumption. So this is going to be our key measure. So different individuals over different months, their Ali frac, their variation will be the key identification for us in terms of the fintech adoption. So we also have individuals' location information. So if you aggregate these individuals over different cities, this is early 2017, this is the end of 2018, you basically see a blue wave. Behind this blue wave is people using more and more Alipay. So people are using this QR scanning. Okay. And that is an indication that these individuals are adopting this new technology. So we're going to use that variation to identify fintech, the variation of fintech adoption. So this is a table, overall a table summarize all the key variables. So this is fintech adoption. This is something I just talked about. On average, the Ali-FRAC is about 55%. And we also take advantage of changes in Ali-FRAC rate later. So we track the same individual from 2017 to 2018. Okay. On the left-hand side here, you have consumptions. We're going to take advantage of their monthly. We see their monthly consumption. So we can, for each individual, we can measure their consumption volatility. So for monthly consumption volatility, this is 1.2, not percent, 1.2. So online consumption is rather volatile for individuals. On the right panel here, we have the risk-taking measure. These are going to be the key Y variables for us. So when we think about can fintech influence risk-taking, we measure risk-taking in 3 ways. We look at their participation, whether they invest or not. We look at the amount of wealth they invest in the risky mutual fund. So these are key variables. Participation about 66% among the active users, about 40% among all users in our data. 45% risky share. This is, if you think about the Morton's problem where we solve for optimal portfolio weight, 45% is the solution. Finally, because we see their position, their holdings every month, we can calculate their monthly volatility for their wealth. And you see it's about 2%, annualized to about 6% investment volatility. So these are going to be the key measures. With these key measures, we are ready to show you some results. So the first question is, can fintech improve risk-taking? And here we are looking at individual level. So the variation in fintech adoption happens at the individual level. If you think about this Ali-FRAC, that fintech adoption measure, if it moves from 0 to 1, it corresponds to about 12 or 13% in risky participation. Just so you remember, the overall sample is about 38%. In terms of risky share, it's about 13%. And if you remember the overall sample, the average was about 45%. In terms of their portfolio volatility, the improvement is 43 basis points. And if you remember, the overall magnitude is about 1.17. Okay. And the table adds a little bit more texture to that result. If you take a look at this coefficient, these are exactly the coefficient I pulled them out. And the t-stats are in the parentheses. Okay. What's interesting is that if we add additional variable like sigma c, which is the consumption volatility, you see that there is a pretty strong positive relationship between risk-taking and consumption volatility. Just so you know that these two are happening in 2 different platforms. One is on Alipay, the other is on Taobao. Okay. One is online consumption, sigma c is online consumption, and sigma w is their portfolio. So this is a very nice setting where you put consumption and investment into the same place. And the other control variables are kind of given the limitation of time, let me skip. Okay. Another way to look at this result is you look at the relationship between Ali-FRAC and their risk-taking. You basically see overall same trend. We further track the same individual, look at their fintech adoption, look at their fintech adoption change from 2017 to 2018. So just to give you some order of magnitude, if you change Ali-FRAC, your fintech adoption from changes is 1, then the changes in participation, the same individual, their changes in participation, you can see economic magnitude is much smaller relative to the early result. Changes in risky share, however, you can see stay pretty robust. Okay, so as you know, this is a very stringent test. You follow the same individual, you look at their changes in fintech adoption, then you look at their changes in participation and risky share. Okay. And looking at this map, you can see the overall change in fintech adoption. And this is the result given these numbers. And also interesting is that previously important control variable, they don't play a role anymore, because when you look at the changes in risk share, the individual characteristics don't matter as much. We further actually do panel regression with fixed effects. Let me just say, even you kill all the variation to the bare minimal, we still have kind of interesting significance. This is individual months city fixed effect. You basically left with the idiosyncratic variation in the individual. You still get about 2% of risky share. Okay. So overall, this is a whole picture of how fintech adoption improve risk share at the individual level. We also look at the city level. City level, because they're less affected by individuals' self-selection. But what's more interesting is that we can do an IV test. So the idea is that if you know China, Hangzhou actually is very close to Shanghai. So these are two dots at the center of this fintech adoption, fintech penetration. So we are using distance to Hangzhou as an instrument for that fintech penetration. So if you look at this panel, distance to Hangzhou, and then we do the first stage with different kind of radius. And then you can see for Hangzhou, it's stable. 200 kilometer, 500 kilometer, really stable magnitude, meaning the variation into distance to Hangzhou correlates with the variation in the fintech adoption. And as you know, Shanghai is very close to Hangzhou. Maybe it's really just big city effect. What's interesting is that within 200 and 500 kilometer, the distance to Shanghai doesn't matter, which makes sense because when you, like Jiao, outside of China, you look into China, distance between Shanghai and Hangzhou is negligible. But for somebody within the 500 kilometer, then that distance is huge, it's very important. So that's why this variable is a very nice instrument for us to detect, to capture the exogenous variation in fintech penetration. So this is the second stage result. So if you compare OLS versus the instrument, you can see if you use all cities, the order of magnitude are more or less the same. But within 500 kilometer, then the instrument actually is stronger both in economic significance and statistical significance. So this is kind of add more, hopefully my causes convince me that IV, you have to do an IV. So I think this is an interesting enough IV for us to report. So this is the result for the IV test. The last piece. So hopefully I established that fintech can really improve investors' risk taking. So the last piece is who benefits more. So given the limitation of the time, let me just say, we find that for risk-tolerant individuals, they invest more. So how do you measure investors' risk tolerance? Okay, this is, MBA students always ask us, how do you measure? So here we have this quite, I would say, innovative measure we take, because we not only have their investment data, we also have their consumption data. So we take their consumption volatility. If you think about the Morton setting, then because consumption to wealth is a constant, so consumption vol, wealth vol, a portfolio vol, they are of the same order of magnitude, driven all by market volatility. So behind this sigma, behind this volatility is investors' risk aversion, inversely proportional. Why? Because that affects how they invest, how much they invest in risky assets. So we use sigma C, consumption vol, as a proxy for risk aversion. We find indeed investors who have higher consumption vol have invested more in risky assets. And moreover, we can quantify, because you think about risk taking, you think, well, more risk taking, is this really good? Well, in finance, we have the sense of optimal risk taking. So within the Morton setting, optimal risk taking across individual will say individuals with higher sigma C, they should have higher sigma W. Okay. So we actually look at the alignment of their portfolio vol and look at their consumption vol, and we see that the alignment is actually very close, well, very substantially closer to Morton's optimal solution for people with high fintech adoption. So I don't have time to talk about, so let me just wrap up. The last piece is that we also look at cities that are underserved. We use bank coverage, how many local bank branch as a proxy for financial service. We find that indeed banks underserved area benefits more from fintech penetration. So I will skip these nice plots. Hopefully we will have more time to talk about them in our discussion. Let me just conclude. So we study how fintech can help households move towards optimal risk taking. Fintech adoptions first improves and more for risk tolerant individual. They also improved alignment between investment and consumption. We find cities with more bank coverage benefit more from fintech penetration. How do we interpret our finding? Well, fintech convenience reduced the physical cost, increased these participation. And also repeated usage in Alipay builds familiarity and trust and increase or optimize risk taking. If you think about the future of fintech, I would say it's brighter for emerging countries. And that's why my co-authors get to present our papers to several emerging countries' central bank, because they are thinking about having more financial inclusion through fintech. Finally, I hope these tech firms can use more finance so that they have more content building and make this next stage of fintech adoption penetration better. Sorry for running over, and thanks.
A little bit. And before that, let me just remind everybody, if you have questions, please either type in or you can raise your hand. I do think that we have enough time for useful discussion after John's talk. John?
Thank you very much for having me. It's really a pleasure to be here and to discuss this really, really very interesting paper. So, you know, the summary is it's a fascinating paper. It's on a very important topic, and the data are absolutely extraordinary. You know, as John explained, fintech is transforming the financial system, and it's doing that in China particularly dramatically. And the fascinating thing, I think, for us researchers is that as fintech changes finance and indeed the whole economy, it also generates the data that we need to understand the process. So that's not always true with economic transformations, but in this case it is. And so that creates tremendous opportunity for research. So what does this paper do? Well, you know, there's a nice statement right at the beginning. This paper examines how fintech can lower investment barriers and help households move toward optimal risk-taking. And John went through that very, very nicely. Now, in my discussion, I'm going to cover three topics. First, I'm going to talk about the data. What really are we measuring? How do we interpret these data? Second, what is the evidence on whether fintech usage stimulates risk-taking or lowers investment barriers in the phrasing of the paper? And if it is true that it stimulates risk-taking, is that a welfare improvement? Is it actually a move towards optimal risk-taking? So those are the three questions I want to ask in this discussion. So what are we measuring? Okay, so, you know, I had to learn a lot about the Chinese consumer economy to even begin this discussion. So I understand that Taobao is online spending. The paper calls it the Amazon of China. Okay, I get that. And Alipay is QR code scanning payment of physical goods. And the paper uses the word offline, which it is, of course, from the consumer's point of view, you know, from another point of view, it's all online. The QR code scanner is using the internet, just like everything else. But from the consumer's point of view, it's offline. It's physical shopping with this convenient form of payment. Both Taobao and Alipay are market leaders in their segment, and the paper is measuring this ratio called Fintech, which is Alipay divided by Alipay plus Taobao spending. Now, if you think about what that ratio means, in the long run, it should reflect consumers' preferences for online versus offline shopping. So I, for example, hate physical shopping, and I order everything from Amazon if I possibly can. So probably even in the long run, I'm going to show up as, you know, a low fintech person. But in the sample period, I think, you know, the paper makes a good case that this ratio is a proxy for the adoption of the new QR code scanning technology. And so it measures, if you like, tech savviness, and the paper uses that term. So I think in this sample period, you can use this ratio in the way the paper does, but I would just caution that in the long run, when we reach the equilibrium where all offline shopping is Alipay shopping, then this ratio is going to be much harder to interpret, because tastes for online versus offline shopping are really going to matter. Now, the paper has these, you know, an interesting little table with some statistics on consumption growth rates, either aggregating the whole economy or aggregating this sample. And a few things jump out. One is the top right-hand number here on the slide shows that Alipay spending is growing in this sample at 5.5% per month. So, I mean, it's just roaring up. Another thing we notice is that consumption growth overall, whether we look at the whole economy or this sample, it's very volatile, okay? It's a standard deviation of 5.25% per month, or about 18% annualized under the, if we annualize using the usual formula, which assumes IID growth rates. So, you know, it's a very volatile economy, volatile period for consumption growth. Then when we look at Taobao, you know, your jaw drops when you see the volatility, because this is 21% per month, or 73% annualized under the usual IID assumption. But this forces one to ask, is that IID assumption reasonable in this case? What are the dynamics of Taobao spending? And the paper kind of shows it to you, but not very directly. But I'll show you the plots from the paper. The first thing is these consumption ratios. The blue series is the Alipay to Taobao ratio. Now that's kind of like the fintech ratio. It's a transformation of it. Might be better to stick with one ratio and just always show that. But the point is that Taobao, and then the red series is online spending divided by all spending. And you can see how online spending, as John mentioned, it peaks at the end of the year. I think of that as the holiday season. John mentioned November shopping days. But in any event, there's clearly this seasonal spike in online spending every year, and then a drop-off around the Chinese New Year. So that moves around the blue series as well, the Alipay to Taobao ratio. So there's a lot of seasonality in these data. That's the first point to note. You also see this when you look at the volatility. This is another plot from the paper, and there's seasonality in all these consumption series in the volatility, but it's extreme when you look at the online and Taobao series. This is some sort of monthly UMA, exponentially weighted moving average. I don't think the paper says what the half-life is of the UMA. It's a little hard to figure out, but this kind of seasonality and volatility is a smoking gun, that there is extreme seasonality in the underlying series, which is showing up in the volatility of these growth rates. You also see a little bit of instability in the consumption shares. This is the breakdown of what people buy online. And you could see it's it's reasonably stable, but you can see that there are these little peaks in the what's called development. I don't know really what that means, and the corresponding troughs in basic goods. So there's some sort of shifting of the composition of consumption at a seasonal frequency. So, you know, all of this evidence suggests that monthly consumption growth is not an IID series, and it's going to have, if it's got this much seasonality in it, it's going to be, the growth rates are going to be negatively autocorrelated. And that means volatility at longer horizons ought to be computed directly, not imputed from monthly volatility under an IID assumption. And the growth rates of consumption really should be adjusted for seasonality. And it raises the question of to what extent is there durability of purchases? I mean, even goods that are classified as non-durable are in fact durable. You know, clothing, for example, is clearly durable. And even things like restaurant meals can be durable in the utility they provide. So, I mean, there's a academic literature on this. You know, Ravi Jagannathan years ago had a paper arguing that the consumption CAPM works better if you measure consumption growth from Q4 to Q4, from holiday season to holiday season, because that's when the big spending decisions are made, and you get messed up if you use other times of year. So I think this needs a lot more analysis for the Chinese context. Now, when we get to individual online spending, the volatility goes up by another order of magnitude. The individual volatility of online spending growth dwarfs the aggregate number. This sigma C here is 1.21. That's 121% per month. And, you know, I'm not going to annualize that, assuming it's an IID series. I mean, even more so than the aggregate number, this has to be adjusted to take account of seasonality and durability. I think what's going on is that individual online purchases are lumpy, and some of the lumpiness gets smoothed out by aggregation, but for individuals, it's extremely lumpy. And without such an adjustment, you cannot use this sigma C variable, consumption volatility, to measure the overall risk exposure of an individual. It's just not representing that in any way. So I think that's kind of an important point to keep in mind. Okay, now let's go on to the second question, which is whether fintech stimulates risk-taking. So the paper, again, it has this really interesting data, and the authors are able to measure mutual fund purchases and sales on the investment platform, which is part of Alipay, owned by the Ant Group. And then for a shorter sample period, they actually have holdings. So for about a year, a little over a year of data, they have holdings. And then they clean up the data a little bit. Some users have really trivial purchases and they get excluded in a smaller sample of active users. And then they've got 3 measures of risk-taking. The risky mutual fund participation rate. So what fraction of people have any risky mutual funds? And that's about 2/3 on average in the active user sample. The risky mutual fund share within the portfolio, and that's about 45% on average. And then the monthly portfolio return volatility. Obviously, you have to measure holdings to measure that. And that's about 1 3/4% monthly on average, or just over 6% annualized. So, by the way, the moment you see that and you say, okay, 6% return volatility, that's reasonable. That's like data and know and love. Then you contrast that with the sigma C we were just talking about, the consumption volatility, and you can tell that you really can't kind of compare those things. Now, the basic fact is that these 3 measures of risk-taking are all positively correlated with the fintech spending ratio that we looked at, and with the measured consumption volatility. So that's sort of what's in the data, and there are some tables that illustrate this with regressions. So here's a regression table that predicts fintech spending. Either this Alifrac is, you know, Alipay spending divided by Alipay plus Taobao. The other measure is log alley count, which is the number of Alipay purchases. So this is, they call it tech savviness, and you're predicting tech savviness. And what predicts it? Well, one thing that predicts it actually is this sigma C. So this volatility of the measured online spending is predicting tech savviness. Then there's log C, that's just the log level of online spending, and that comes in negatively. Well, why is that? That's because essentially it appears negatively in this ratio that we're predicting. So, it's almost a mechanical effect that it's going to come in negatively. And then you have there's a small gender effect. Interestingly, there's no age effect. I might have expected, old fogies like me to show up as non-tech savvy, but that doesn't appear to be the case in China. And then these are city level controls for income and so forth. If we look at what predicts risk taking, this is at the individual level. This is the full sample of 50,000, and we're just looking to see whether they participate. And then this is the smaller sample for which we can estimate the risky share. There's more in the table. There's some stuff about return volatility, which I didn't paste in. But the basic fact is that the tech savviness measure comes in positively, even when we include sigma C, which also comes in positively. All of these things are positively correlated. So the paper argues that fintech causally encourages financial risk-taking, presumably by lowering various costs of buying risky mutual funds. They might be financial fixed costs, they might be hassle costs, they might be information costs. It just makes it easy to buy mutual funds. Now, this is very plausible. I actually believe it's true, but it's hard to demonstrate conclusively. And, the role of a discussant is to be the identification police and be skeptical. The obvious difficulty is that omitted variables such as general intelligence, market-oriented education, social connectedness, or the psychology of being open to new experiences, any of those omitted variables could easily drive, at the individual level, could drive both fintech spending, adopting this new technology, and financial risk-taking. So to address this, as John explained, the paper uses a geographical approach and shows that if we compare different cities or local geographical areas in China, fintech penetration, the overall rate of fintech usage in the city, predicts risk-taking in that city. We can control for city fixed effects by working with changes. Change in fintech penetration predicts change in risk-taking. And importantly, fintech penetration predicts risk-taking when instrumented by the distance from Hangzhou, the Alibaba headquarters city. I think the remaining concern is whether it's sort of always true that new things, new social and economic trends, generally emanate from Eastern China and then spread outwards. So if the results were just driven by the overall pattern in China as a whole, I would be particularly worried about this, because it just seems that it could easily be that a lot of things are flowing out from that very dynamic Eastern Chinese region and reaching other cities and areas according to their distance. And that could have happened for fintech. It could have happened for whatever else is driving risk-taking that happened to occur at the same time. That's the concern. Now, Jun did address this to some degree with her evidence on the sort of local, within the Eastern China region, local to Hangzhou and Shanghai, within 200 or 500 kilometers. It seems to work when you use distance from Hangzhou, not when you use distance from Shanghai. So that's kind of an interesting point. But I think, it's going to be hard. I'm not really a hardcore identification skeptic. There are going to be hardcore people out there who will be very hard to convince just with this geographical approach. But for my taste, I think it's very plausible that fintech does encourage risk taking. Now, where I get much more skeptical, and I'm going to end with this, is whether this is a good thing and whether it is welfare enhancing. At some general level, there's an argument to be made for this, which is this. Financial economists generally argue that all individuals should have some equity exposure to earn the equity premium. Why? Because that premium is positive, and if you start with zero risk, then and if you have twice differentiable utility, you should take some small amount of any positive return risk. But of course, lots of people don't do that. There's a low observed equity participation rate, which may reflect fixed costs of equity market participation, hassle costs, financial costs, or behavioral biases such as ambiguity aversion, which I think of as a behavioral bias. But either way, we could say that's a social problem. Some people are not earning the return that they may need to sustain a good standard of living in retirement. If fintech lowers these fixed costs and encourages participation, that's likely to be a good thing. So at that general level, I'm okay with that. I believe this argument. So far, so good. The problem, I think, is the paper goes much further and makes a much stronger argument. So the paper appeals to the Morton model of optimal risk-taking. And, famous textbook model, we've got an infinite-lived investor, living off financial wealth only, returns are IID, optimal portfolio risk equals optimal consumption volatility, sigma W equals sigma C, and both are driven by risk aversion. So the formula is that both these volatilities are the Sharpe ratio of the risky asset divided by risk aversion. And the paper shows that fintech is associated with a stronger cross-sectional relation between sigma W and sigma C as measured in the data. And, let me just show you the slide. They normalize both sigma W and sigma C. I think, if I recall correctly, the normalization is to divide by the cross-sectional standard deviation. So it's sort of like z-scoring the thing. And so some people have low consumption volatility, some people have high consumption volatility, some people have low portfolio volatility, other people have high portfolio volatility. Is it the same people who have high and low consumption and portfolio volatility? And the key result here is that this scatter diagram is based on binning households, but the key result is that among the high fintech users, the slope of the line is steeper. The relationship is stronger between these two types of volatility. Okay, so this is the framework, and this is the argument that we've moved closer to the optimal Morton world by using fintech. Now, here are my problems with this. Okay, the first set of problems has to do with the data. Okay, we saw that sigma C is, on average, it's almost 2 orders of magnitude greater than sigma W. Okay, so this is not what we're not in a Morton world. These measured concepts, sigma W and sigma C, cannot possibly correspond to the objects in the Morton model. And I've already told you why I think the spending volatility series, is problematic. You've got to handle the lumpiness of spending, the seasonality, and all those things. And then for the wealth volatility, that seems to be well measured for the financial volatility. But of course, it excludes any kind of implicit wealth from non-financial assets, housing, say, or from human capital that you would really need to apply the Morton model. A Morton model is for an investor who just lives on financial wealth. So you really need to bring in all components of wealth. All right, now suppose we could solve these measurement problems and you had the true sigma C and the true sigma W. Well, the problem then is that the equality of wealth volatility and consumption volatility is really an implication of the intertemporal budget constraint, not optimization. I mean, if consumption growth and returns are IID, then the budget constraint is going to force the consumption wealth ratio to be constant, and the two volatilities must always be equal. And more generally, the two have got to be equal at long horizons, provided that the consumption wealth ratio is stationary, which is a very weak condition. So the alignment of wealth volatility and consumption volatility tells us nothing at all about whether investors are choosing portfolios that match their risk aversion. It just tells us whether we've got consumption concepts and wealth concepts that seem to satisfy the intertemporal budget constraint. If you want to know whether investors are doing the right thing given their risk aversion, you've got to have some independent source of risk aversion data. For example, survey questions where you ask people how risk averse they are. Otherwise, you cannot learn about this question. Now, that sounds very negative and kind of nihilistic, but let me conclude with a more constructive suggestion. I think there's a more promising way to go. Let's think about another implication of the Morton model. In that model, investors should only take compensated aggregate risk, and they should not take uncompensated idiosyncratic risk. Hence, in the model, consumption and portfolio returns should be perfectly correlated cross-section because there's perfect risk sharing. And they should be perfectly correlated with the aggregate market return. This is where risk comes from, is the aggregate wealth portfolio. Now, that's not quite going to apply to the real world. In the real world, people have risky income. Maybe they could use their portfolios to hedge that income risk, in which case different people would hold different portfolios. But I think with realistic degrees of income risk, the theory of optimal investing a la Morton, suitably enriched, still implies that consumption growth should be very highly correlated across investors. That's the point of risk sharing. And consumption growth should be highly correlated with the aggregate market return, because that is the measure of the aggregate risk in the economy. We want people to be exposed to that aggregate risk to earn the equity premium and to share risk broadly across the economy. But we don't want people to be taking a lot of idiosyncratic risk. So let's ask. I think the authors should ask, is fintech associated with increases in these correlations? Is it the case that when you have a lot of fintech with people buying all these mutual funds, that their consumption growth gets more correlated with each other and more correlated with the aggregate Chinese index or a world index? If we don't see that, it's possible. I don't want to insult Chinese investors. I don't know the data and I don't know what's going on, but it is possible that Chinese investors are using risky mutual funds to speculate and to increase their idiosyncratic risk exposure rather than to earn the equity premium or to hedge income risks as financial theory would recommend. But the good news is we can measure this. And I think it's a fascinating question, and I hope the authors will go in that direction. So thank you very much. That's all I've got.
Thanks a lot, John. I strongly concur the last point. That is something that actually when Jun was presenting, it's the first thing I thought about. As a host, I have a privilege to ask you a data question. I do think that all these things boils down to the measurement, and I don't know how much that you put into the effort into showing that, for instance, that when the individuals increase their mutual fund holding, where is money coming from? Or there initially was inside still the Ali system or something outside? If it's the outside, then I just do not know with what kind of things. They might move from other savings to here, or they might move some other risky investment to here. That is in my mind, was a lot of times when we think about these questions, given that China, not from the investment side, Alipay or Ali system isn't. I don't think that's a leading system. There are a lot of security firms offering these services. So I would pay attention to these questions. And I do not know the answer. Maybe that you have more data to clarify this question. Jun, you might respond quickly, and then there's some other questions.
I thought you were asking Jiao a question. I was still thinking about Jiao's comments on the
I'm sorry.
Sigma W. So, but I'm very glad that Jiao, very glad that we are recording this session. So I would definitely, I didn't fully digest, but I see the key points. In terms of Sigma C versus Sigma W. I think the paper itself is interesting enough without this optimal alignment. But I wanted to, given that we learned this Morton's model in grad school, I feel like it's a perfect opportunity. I've never seen this in the literature, is that to calibrate Sigma C with Sigma W. But I take your point, is that such a volatile component of Sigma C, how could it be informative? So we will have to think more about this. I did notice that Sigma C is much more volatile. So that's why we scale it by the cross individual variation, the cross individual standard deviation. So we are hoping, so my intuition is that even though Sigma C as a level doesn't capture the consumption, the true consumption volatility, but from individual 1 to individual 2, the cross-sectional variation that captures their risk aversion. But from your response is that even that is not an informative measure. So, but that correlation dimension in terms of consumption correlation with the market portfolio, that's something we can definitely take a look. Thanks so much for the last part of that discussion. That's really informative.
All right.
I'm
so
sorry. I was thinking about that.
Ask the data question. How do you know that the money, that the increase in the mutual fund is coming from the SAIF savings?
Oh yeah. So we actually have different components of mutual funds. So in the table of the paper, we have, by equity, bond. We even have gold. I think in the gold side, gold mutual fund investment, it reflects something that's very different from equity and mixed funds. That's, I think that's something that we can explore a bit more.
Yeah, my key question is,
do
you see that they are moving money from outside the Ali system into it, or you do see that it's a shift inside the Ali system?
Oh,
because,
actually, yeah. We didn't. Well, Xiaomeng and Claire, they are also on the panel. They could chime in as well. But
that's fine. That's just worth clarifying.
Yeah. Mm-hmm.
There are some other questions like one suggestion is the saying that maybe there's some Robin Hood effect in the sense that cross each other, seeing like a neighborhood effect. It's a slightly tangential point. Maybe it was worthwhile to thinking.
Initially, we tried to tell that story. I mean, look for that story in the data, but I don't think we find anything useful.
Mm-hmm. Mm-hmm. Mm-hmm.
The co-movement within locations, or some social connections between these investors, but we didn't find anything useful there. We didn't see it in the data.
Yeah. The last one will be that it's related to my point, is that in general that I thought that will be useful for the entire country to making more equity investment in a regulated way or healthy way, and that helps the saving, addressing the saving issue, etc. So Bing was asking that in your data, can you see that the fintech adoption increase the consumption or actually increase the saving?
I don't. I don't think so, because you can see overall the consumption Taobao. We only see a snapshot of consumption. We don't see the entire consumption, but within the Taobao consumption, the trend is pretty stable. So in terms of the social benefit, that's why I think if we can address the optimality result, it's really satisfying for me personally, because in another paper, Xiaomeng and Claire, we look at how these mutual fund purchases through the online platform, they affect the aggregate mutual fund performance chasing. We see that once the mutual fund distribution move online substantially, you see a dramatic increase in performance chasing. So I think there is a dark side to that fintech platform. That's why I think you need more finance component to this fintech platform. And that's why I think having that optimality is important. It's not just more risk taking is good. It's really optimal risk taking. So we don't have the right. We're not convincing yet, but we are hoping to get to that point.
You know what? I wonder whether one thing you could do would be to sort of analyze the portfolio holdings a little more carefully. You know, if you impose a model of returns, for example, a CAPM or a multi-factor model, and you can take individual portfolios, and if you have your model determining the expected returns on each asset, you can calculate the Sharpe ratio of each portfolio and look at optimal diversification. I mean, I did that in work with Calvé and Sodini using Swedish data, and you could do it with your Ant Group data, and you could see whether the Sharpe ratios, you know, how close do they come to the maximum Sharpe ratio. Obviously, that has to be conditional on a model, because you can't use people's ex post returns to calculate their Sharpe ratio, because that'll confuse luck with skill, you know. But I think imposing a model is a pretty reasonable thing to do, and many people have done it in the literature. So that would be another way to go.
Right. Yeah, but I'm hoping to use that consumption part of the data. That's kind of a part of data you feel like there is some information, and how do you extract the information from there? So we would take your correlation observation. We would take the model more seriously and see the prediction. Yeah, thanks for these comments.
All right, I think that today we the time is up now. Our next meeting will be on July 1st. It's on demonetization in India. That will be presented by Sumita Agrawal. But Bernie, you might want to say something else.
Oh, I want to thank both Jun and John for really stimulating presentation and discussion. By the way, I do want to raise another point about lowering the barrier that John mentioned. The optimality, the welfare effect, we need to be careful. I think there was, in the main conference, there was a paper about opening up all this, lead to some kind of chasing after the winners take all in the mutual fund market. So maybe this is another direction we need to think about. When you lower the barrier, what's the consequence in the behavior of the consumers and the investors? Again, I want to thank everyone for participating. John and Peng Jun, thank you. John, I hope that you have a good rest tonight, and I'm very happy that in July 1st we are having an India paper. Like Zhiguo just mentioned, it will be digital payment and consumption evidence from the 2016 demonetization in India. And I want to encourage all the audience, please suggest papers that may be useful, that may apply, that are from other parts of Asia, not just China. We now have China, we have India, but we need more from Korea, Japan, and other places. So again, thank you very much, everyone. Thank you for great way for me to start the day. And John, have a good rest. And Benjamin, thank you very much. I really appreciate all the very meaningful and very constructive comments on the work. Thank you.
Yeah,
Thanks, John. Thanks, Jen.